Hey traders, and welcome back to the channel. Today, we're diving deep into a strategy that has captured the imagination of countless new traders, the Martingale strategy. It's a concept so simple it almost feels like a cheat code, and it promises to turn any losing streak into a guaranteed win. But as we'll see, this promise comes with a dark side, a path to an inevitable and devastating account blowout. So, what exactly is the Martingale strategy? At its core, it's a method for recovering losses by doubling your position size after every single losing trade. The logic is based on a simple principle of probability. In a purely random series of events, like a coin flip, a long losing streak is statistically unlikely. So, by doubling your bet, you're building a massive position that, when it finally wins, will not only recover all your previous losses, but also secure a small profit. Let's walk through a simple example. Imagine you're trading Euro USD. Your first trade is a standard lot, and it's a loss. According to Martingale, your next trade must be 2 lots. If that's a loss, you increase your position to 4 lots. Another loss? You're now at 8 lots. The sequence continues. 1, 2, 4, 8, 16, 32. You can see how quickly the numbers spiral out of control. When you finally hit a winner, say, at the 16-lot stage, the profit from that one trade should be enough to cover the losses from the 1, 2, 4, and 8 lot trades combined, plus a little extra. It sounds like a perfect system, right? A guaranteed way to beat the market. However, the reason this strategy fails is because it's based on 2 critical and ultimately fatal assumptions. First, Martingale assumes you have an unlimited capital. The reality of trading is that your account balance is finite. As your losing streak extends, and let me tell you, streaks of 10 or more consecutive losses are not just possible. They are statistically certain to happen over a long enough period of time. Your required position size grows exponentially. A streak of just 7 losses means you'd be trading 128 times your initial lot size. For most retail traders, this would exceed their account's margin requirements after only a few losses, leading to a margin call and the total liquidation of their account. The strategy doesn't fail because the market is against you. It fails because your capital runs out. Second, Martingale ignores the fundamental nature of the financial markets. Unlike a coin flip, the Forex market is not a random walk. It trends. It can move strongly in one direction for weeks or even months at a time. If you're using Martingale to buy against a powerful downtrend, each successive trade is not just bigger, it's a bigger losing trade. You're essentially adding to a position that is moving against you, digging a deeper and deeper hole until your account collapses. The Martingale strategy essentially turns a series of small, manageable losses into one gigantic, catastrophic wipeout. But what about the solution that every trader is taught? The stop loss. A stop loss is designed to protect you from catastrophic loss, but it too has its limitations. Market volatility can cause a price to gap right over your stop loss level, especially during major news events or over a weekend. You might have intended to lose only 10 pips, but the market's jump causes you to lose 50 or 100. So while a stop loss is a crucial risk management tool, it is not an infallible solution. This is where the Martingale trap really shows its teeth. The allure of its guaranteed recovery can make a trader disregard proper risk management, leading them to abandon stop losses entirely. They become convinced that they are invincible against a losing streak, but the market has no mercy for such hubris. It will eventually deliver a losing streak that no amount of capital can sustain, and in that moment, all the small wins and recovered losses become meaningless. So, if Martingale is a ticking time bomb and a stop loss can sometimes fail, what's a trader to do? The answer lies in a different approach, one that doesn't rely on doubling down or getting stopped out by volatility. That's where the RobotFX auto recovery comes in. This expert advisor uses an advanced zone recovery algorithm to manage losing trades. Instead of doubling down or getting stopped out, it opens opposite direction positions to protect your equity and contain the loss. It then strategically opens new trades in a different direction to capitalize on market moves and slowly recover the drawdown, turning a potential loss into a profit without the need for Martingale's exponential risk or a conventional stop loss. It's a method that works to recover losses intelligently, without exposing your entire account to a single catastrophic event. If you're tired of the endless cycle of winning small and losing big, and you want a smarter way to manage your trading risk, you should check it out. You can learn more and download the EA from their official RobotFX website. It is free to download and fully functional for demo trading accounts, so you can test it risk-free. It's a risk management solution that truly puts your capital first, offering a disciplined and systematic way to navigate the inevitable losing trades that are part of every trader's journey. If you really want to be successful in trading Forex, you must stop using a stop loss and download this MetaTrader EA. Good luck trading, and many green pips to you.